Thank you. Good afternoon. First, let me thank you for giving me the opportunity to speak today. I missed out on last year. Actually only had a few minutes before the board during the regular public hearings. And allow me to offer congrats and condolences to the newly appointed members and the new chair. I think it's going to be a tough season in a lot of ways, but hopefully a better one than we've seen in the past. And also let me thank the RGB staff for another round. I mean, I was here as executive director and council many, many years ago, and they consistently do wonderful work and improve it every year. And a special recognition to my old friend Leon Klein, who's actually handing my stuff out now. Leon has been monitoring the finances of the RGB staff for, I think, 30 years now, and he used to drive me nuts with his bean counting, but he never made a mistake, and he often goes unrecognized, so thank you, Leon. As I said, from 1997 through 1994, I served as counsel and director of the board. In the late 1990s, I worked under contract for the board to update and complete various briefing materials that are included in the introductory materials to the board, which are located on the board's website. Each year, the board is presented with a dizzying array of statistics regarding the state of the city's rental housing market. What should you consider? How much weight should you give to the findings in the reports? And what is the ultimate role, your ultimate role in the rent stabilization system? I should say that, after hearing an excellent presentation by Patrick Marquis, sort of outlining the human consequences of high rents, I want to take, I have 2 points of, I suppose, departure, not really disagreement. One is, I think it's vital that the board understand what is happening in the housing market in terms of affordability in many levels. But it is not the role of the board to make sure that every apartment is affordable. The fact is that when incomes decline, there are some people who will not be able to afford housing. It's not your job to make them all affordable. It's also not your job to make every building profitable. Your job is to try, as I will explain, to simulate what would be a normal market in the absence of the abnormal conditions that the city experiences. The other point of departure I would have with Patrick, and I should state that for many years I was very reluctant to ever suggest any guidelines by the board. I stayed away from that. I presented information, let the board make its decision. But in more recent years, I have called for rent freezes. And this year, and where I would depart from Patrick's suggestion, is I would not call for a rent freeze. I think it's absolutely vital that this board start to roll back rents. And I will explain in detail why that has to be done, why it has to be done soon this year. Okay? Let's look at the board's legal mandate. You're charged with reviewing the economic condition of residential real estate, including real estate taxes, sewer and water rates, gross operating maintenance costs, fuel and labor costs, costs and availability of financing, which you have in your mortgage report, the overall supply of housing accommodations and overall vacancy rates, relevant data from the current and projected cost of living indices, and such other data as is made available to you. The declaration of emergency contained in the rent stabilization law rests on a finding that a chronic and severe housing shortage persists. This central fact establishes a broad frame of reference within which the specific economic factors which I just outlined should be considered. The board's right to consider the overall supply of housing and such other data as may be made available to it demonstrates the board operates with considerable latitude, and that the mandated considerations need not be applied in a mechanical fashion. However, the board remains accountable to the public through published justification, which connect its orders to the mandated considerations. And that justification is included in its annual explanatory statements, which are required and published in the city record every year. You are, in a sense, an economic court of appeals. Appeals from owners, appeals from tenants, and appeals from a public that is concerned with market stability, housing quality, and increasingly with housing affordability. When considered as a whole, the declaration of emergency and mandated considerations compel the board to attempt to construct or to simulate normal market rents where abnormal conditions prevail. This is no easy task, but you have plenty of tools at hand. Some may well argue that it is rent regulation itself which creates or perpetuates these abnormal conditions, but there is no good empirical evidence for that claim. New York City has not had a normal housing market for well over a century, long before rent regulation was ever introduced. As a port of entry for millions of new Americans and those who came from other parts of the country, New York has weathered strong and sustained demand for rental housing since the first tenements were constructed in the 1830s. As its population has grown and special quality of life issues have intensified, the city has been forced to manage growth in ways that suppress or otherwise raise the cost of new housing supply. Strict zoning laws, strong building codes, landmarks preservation, a host of other quality of life and safety-related regulations artificially but necessarily create housing scarcity and drive rents up. These impediments to supply, common to nearly all urban areas but most pronounced in New York, greatly benefit the owners of existing rental buildings, giving them a quasi-monopolistic position over a basic human necessity. In the absence of rent regulation and other housing-related laws, owners would undoubtedly demand exorbitant rents and impose harshly one-sided lease terms, as I have often witnessed in the city's market rate housing sector. Those who argue that what is fair is what the market will bear fail to recognize that there really is no meaningful competitive market in New York City. Net vacancy rates in the city have hovered around 3% for the last 15 years. Nationwide, rental vacancy rates have fluctuated from between 8 and 10%, and sometimes a little bit more over the same period. Any claim that rent regulation is the cause of low construction levels is simply not supported by the evidence. The city's two largest housing construction booms occurred during the 1920s and over the 2 decades following World War II, both periods when strict rent controls were in effect for previously built apartments. New construction has almost always been exempt from rent regulation, though owners may voluntarily opt into the system in exchange for generous tax abatements. I should note a lot of people don't know that we had rent controls in the 1920s, but we did, and they were quite strict. Getting back to the board's immediate task and the tools available to it, how does the board go about establishing rents that might otherwise exist in a normal market? Certainly a review of changes in operating costs is essential. As costs go up, so generally do rents. But by now, members should recognize that the two major instruments available for measuring costs have serious limitations. The income and expense, or I&E data available from the Department of Finance suffers from a lag in reporting for over 1 year, which might be remedied, by the way, if the Department of Finance could process and transmit the data to the RGB more quickly. I'm not sure what the administrative mechanics of that are, but it certainly would help the board in its process if that could be done. The annual price index of operating costs is a measure of a hypothetical market basket of goods which has, over the past decade, substantially overstated actual operating cost changes, as evidenced by the more reliable I&E data. Now, this was presented to you earlier this year in a special report by Jim Hudson, who I believe found that there was, at least in the last decade or so, almost a 2% gap between what the I&E was reporting and what the price index was reporting. Moreover, because it is viewed in isolation without current data on owner income, the price index has chronically provided a misleading picture of the overall health of the real estate industry. You shouldn't be myopically focusing on the price index. You have to look at the whole picture in order to assess the health of the industry. A review of cost changes is incomplete without a review of changes in rents. For that, we have the income data from the Department of Finance, which again suffers from a time lag, as well as the RGB's own rent index, a mathematical projection which factors in the prevalence of 1- and 2-year leases, vacancy allowances, and the applicable rent guidelines. Unfortunately, the rent index has never been used to counteract the one-sided picture provided by the PIOC. I'm going to try and do that today, but I would suggest that in the future, even though it's an imperfect index, it's a projection, it's all we can use at this juncture. It does help, kind of balance, by showing where income is expected to go in contrast to costs. The central and clearly the most important product of all these measures is the operating cost to rent or income ratio. I'll refer to it as the O&M ratio, and the changes in that ratio over time. If the O&M ratio remains flat, owners have been kept whole for operating cost changes. If it falls, owners will see a gain in net operating income because the inverse of that ratio is net operating income. Today you have last reported a 60.5% O&M ratio, which means that 39.5% is left for net operating income, which would include capital improvements, financing, and what I would describe as operating profit, because you cannot measure actual profits in the real estate industry because you don't have a measure of changes in equity, capitalization issues, and so on over time. You don't know how much people put into their properties. You don't know what proportion the banks put into those properties, and what the ultimate return is at the end of the day when those properties are either operated or sold, particularly when they're sold. If the O&M ratio rises, operating costs will eat up a larger portion of each rent dollar collected. Absent other factors, a stable operating O&M ratio is an indication that the board is holding a steady course. If that course permits cost-push inflationary factors like oil, labor, or insurance costs to be recaptured in rent increases, the board is simulating normal market conditions. If that course permits the city's exceptional demand pull inflationary pressures to force rents up, that is, the rent increases driven by an abnormal imbalance between supply and demand, then the board is departing from its mission to establish rents that might otherwise prevail in a normal market. Before turning to the basic trends in the O&M ratio, there are two other factors the board should consider when evaluating whether the prevailing ratio is too high or too low. The first is the relative age of the housing stock. As buildings age, operating costs will generally increase relative to rents, and this is a fairly well-studied phenomenon. It's certainly been the case in New York City as long as housing costs have been examined. The city's housing stock has clearly aged. We have no precise numbers on the median age of the rent-stabilized buildings, but based upon the Housing and Vacancy Survey data, we do know that in 1981, 80.3% of the stock was over 20 years old. By 2011, 94.5% of the stock was over 20 years old. One can easily conclude that new construction has not been sufficient to keep the average age of the stock from rising. In a normal market, this would mean that the O&M ratio would have crept forward from where it was 30 or 40 years ago. 30 or 40 years ago, as I'll go into, that ratio was on average about 62%. And as I will suggest, it should be somewhat higher at this point. The second factor in looking at the O&M ratios is the impact of a recession on rents in normal markets. If household incomes are flat or falling, rents generally dip or sputter along until the economy picks up. This was evident during the recent recession, when the national median asking rent in the first quarter of 2009, $723, actually exceeded the median asking rent 4 years later, or the first quarter of 2013, which is $718. For a 4-year period throughout the nation in the heart of the recession, rents fell. Asking rents fell. But declining or flat rents do not mean necessarily that operating costs will also decline or decline at a similar rate. Unless costs are flat, which we know they are not, O&M to rent ratios will generally rise during a recession. So one can expect that throughout the nation, although we don't have precise numbers, operating costs to rent ratios in the normal market outside of the regulatory context would have risen. In sum, as a structural matter in normal markets, O&M to rent ratios will rise with the relative age of the housing stock. And as a cyclical matter, a recession will limit rent increases or even cause a decline in rents, and this typically results in a rising O&M to rent ratio. So how has the ratio changed over the years? Based upon a 1993 staff study, which constructed an estimate for a mean O&M to rent ratio for the pre-war stock, that's the pre-47 stock, derived from the work by George Sternlieb in 1967, the true O&M to rent ratio estimate fell in the range of 0.65 to 0.70. The staff actually took the more conservative 0.65 number in constructing its overall mean for the stabilized stock as a whole. The estimated mean ratio for the post-war stock was 0.55 or 55% based upon contract rents. Now that is also a conservative number because if the 55% is based upon contract rents, not all of those rents are collected. If you have a 3% vacancy rate, you should have basically 0.55 over, say, 97 as opposed to 0.55 over 100, which means the true O&M ratio for the post-war stock was probably a little bit higher, maybe 0.57. But given the relative portion of the pre- and post-war units, the overall O&M ratio at the outset of rent stabilization was assumed to be 0.62, and again, a conservative number. In sum, using the best evidence available, we can assume that at the time rent stabilization was first adopted in 1969, the average landlord in New York City was spending about 62 cents of rent and income collected on operating costs. And I should note that the figure for the pre-war stock, which is now about 3/4 of the stabilized stock, it included income. It was not just a rent figure, it included income. So in that sense, if it was just a rent figure, the numbers would have actually, or the ratio would have been higher than the 65 to 70. If it was just rent, it probably would have been in the 70s somewhere. But using the 62% ratio, that leaves 38% as net operating income. With the aging of the stock, the ratio should have gradually risen over the years, and a 65 to 68% ratio would not surprise nor trouble me at this point. With access to the I&E data, we can more reliably gauge how the O&M ratio has changed over the past 2 decades, and you do have tables in the general briefing materials as well as in some of your reports which show how that ratio has changed. The ratio has witnessed a steady decline since 2008, in the heart of the recession. 2008 was 64.3%. Looking at this from the income side, when nearly every other investment in the nation, except perhaps gold and silver, were declining, rent-stabilized housing witnessed a significant increase in net operating income. Despite an aging housing stock and sharply declining tenant incomes, which should have caused the O&M to rent ratio to rise and net operating incomes to decline, the actions of the Rent Guidelines Board and the operation of various statutory deregulation provisions sent the ratio sharply down and net operating income significantly up. It is therefore completely unsurprising that the RGB staff now reports that owner net operating income is 31.5% higher in constant 2012 dollars than they were in 1990 when we first got the income and expense data. It's a very, very significant rise in profitability. I think Patrick Marquis, gave a full presentation on the state of tenant affordability. I'm just going to touch on a few points. Between 2008 and 2011, the parallel period that we're looking at in terms of changes in the rents, the average amount of rent paid by stabilized tenants jumped from 31.6% to 34.9%, according to the Housing and Vacancy Survey. More than 1 in 3 stabilized households now devote more than half of their income to rent, and the rates of the city's homeless have risen by more than 40% during that period, and now approach, or I think as Mr. Marquis explained, now actually exceed 50,000. That the previously described massive increase in owner income occurred at a time when tenant incomes were declining, housing affordability problems severely deepened, and homelessness skyrocketed is nothing less than a scandal. These conditions were well known to the board by 2011 and known to members of the press as well. The actions of the board during this period were deplorable. The silence of the press borders on criminal neglect. Just before it took a vote in 2011, Rent Guidelines Board Tenant Representative Adrian Holder clearly identified the problem. In the spring of 2008, the board staff projected that operating costs would rise 7.3% over the coming year. And that was a good faith, reasonable projection based upon the information available to it. There was no, conspiracy or no attempt to push things up. It was just based upon the evidence that they had. But by the spring of 2009, it was discovered that the projection was high. Operating costs as measured by the price index were found to increase by only 4%. Given the lag of information from the Department of Finance, which collects information about income and expenses through tax filings, which you all know, we have only recently discovered that both the projection, this is her statement in 2011, we have only recently discovered that both the projection of 2008 and the price index of 2009 were way off. In fact, during the period of 2008 to 2009, operating costs went up only 0.1%. In 2008, the board adopted rent increases of 4.5% for 1-year leases and 8.5% for 2-year leases. These increases went into effect during the heart of the recession that began in 2008. The following year, rents went up by 3% and 6%. So in the middle of the deepest recession the country has experienced, and again, this is Adrian Holder's statement to the board in 2011, in the middle of the deepest recession this country has experienced since the 1930s, rents were going up dramatically while operating costs were basically flat. This resulted in a huge and unwarranted windfall for owners. The RGB's public members wholly ignored this warning. Sticking stubbornly to the flawed commensurate formula, in 2011, the board adopted one-year increases of 3.75% and two-year increases of 7.25%. Again, owner incomes increased. In 2012, the board further overcompensated owners with 2% and 4% increases, which when combined with the vacancy allowance exceeded operating cost changes. And last year, the board unconscionably awarded owners 4% and 7.75% increases. As usual, the press reported that both landlords and tenants were unhappy, as if that were a fair measure of the appropriateness of the board's action. It isn't. For the past 5 years, in fact, the past 6 years, the board unconscionably and indefensibly inflated owner incomes while the homeless and affordability crisis mounted. It would perhaps have been defensible for the board to adopt these rent increases if reliable cost data supported it. But that has not been the case. It was simply a giveaway to those who needed it least. And it was an abdication of the board's responsibility to establish fair rents under abnormal market conditions. It was a thinly veiled attempt to move towards deregulation. That is the prerogative of elected officials, not this board. For those who have heard me testify in the past, you know that I do not believe it is the role of the board to make every apartment affordable to every tenant. You are not a welfare or social services agency. If apartments become unaffordable because operating costs are truly driving prices up, rent increases may be a necessary evil to sustain the housing stock and ensure a fair return for owners. But if apartments are becoming unaffordable because unwarranted rent increases are simply transferring wealth from the city's tenants to its owners, resulting in record profits for the owners, then it is indefensible. The record now clearly demonstrates that this has been the shabby legacy of this board since the recession began. How does the board get things back on track? There is only one way. The board must act boldly and without hesitation to roll back rents. The needless burdens imposed upon tenants over the past 5 years must be lifted as quickly and as fully as possible. The goal should be to achieve a rent ratio of about 64.3%, which would turn back the clock to the ratio that existed in 2008, which is quite a conservative figure, again, given the age of the housing stock and the recession that we've dealt with. What adjustments are needed to accomplish this? Again, the last measured ratio, as reported in this year's I&E study, is 60.5%. That ratio is from 2012. While there's no perfect method of updating it through the present, we do have some data which allows us to construct a rough estimate. And basically what follows is an analysis of where we know operating costs were in 2012, which is 772, increasing it by an appropriate increment of the price index, which I don't like to use because I think it is overinflated and it is a very conservative figure, but using that, if we increase the 772 through March of 2014, we get a figure of 828. We take the average gross income of 1277 from the I&E study, again 2012, and update it by the RGB rent index, we get an estimated income figure of 1,346 for March of 2014. Combining the two produces a current O&M to rent ratio of 61.5%. Again, not a perfect number, but probably the best we can use at this point. Now, given the staff's projection that prices are expected to rise 1.7% in the coming year, a complete rent freeze on rents would cause the O&M to rent ratio to rise only to 62.5%. If you do nothing in terms of rent increases this year, by the spring of 2015, the rent ratio will only go to 62.5%. If you adopt rent increases in the range of a freeze for one-year leases and a 2% increase for two-year leases, the consequence will be that the O&M to rent ratio will go to 62% in the spring of 2015, and that's exactly where it was 45 years ago. 45 years ago. And again, the stock has aged considerably since that time, and we're in a much deeper, or in the tail end of a much deeper recession than we ever were in the late 1960s. That would be a very conservative outcome. A rent freeze thus brings the ratio only up to the 62% mark. It doesn't account for the aging of the stock, as I mentioned, and the recession. There is simply no reason why the RGB should not allow the ratio to rise to the 2008 level of 64.3%, and there is no reason to delay action on this. As it is, tenants will have to wait until at least until renewals occur between October of 2014 and September of 2015 to begin lifting the burden of the excessive increases of the past. So how is the balance achieved? It can be done in a combination of ways. An across-the-board rollback of 4% would move the ratio to 64%, again, by the spring of 2015. A rollback of 6% on one-year leases and 2% on two-year renewals would move the ratio to 64%. For all the foregoing reasons, this board must act without hesitations to provide relief where it has inflicted so much unnecessary harm. Rents must be rolled back. While this might seem like an extreme recommendation, it is made in the wake of an extreme abuse of the system. In the 25 years I've worked on these issues, I have never been more distressed and disappointed with the board's actions. Beyond this, the press must wake up to the affordability crisis, which is the single greatest source of stress and insecurity in the city today. And in covering this year's rent-setting process, the press must recognize that the inappropriate actions of this board over the past several years have added to the crisis. And I will commend, in concluding, the New York Times for taking a positive step with yesterday's article on how the affordability crisis is affecting the elderly. Hopefully other papers will follow. Thank you for your time and attention.
Thank you very much. First of all, as the recent chair, I can't thank you enough for the introduction to the New York City Rent Guidelines Board and the Rent Stabilization System, which I have read cover to cover twice.
Oh gosh,
because
thank
it
you.
was extraordinarily helpful.
For making it so long.
It was extremely helpful. So this is obviously incredibly powerful testimony and gets to the heart of what we've been sort of talking about and thinking about since all this began, of course. And I guess the question that I would ask that I'm sure will be followed up by my colleagues is, what seems to have been one of the points of contention has been the role, how we should treat income versus rent, and particularly income from sources other than, or even rent that comes from sources other than rent-stabilized units. And certainly, you know, your argument that we should be looking primarily at net operating income and the cost-to-income ratio is powerful and convincing, but I'm curious to hear your response to the argument that some have suggested that that's not the appropriate unit. Just one quick follow-up point. Particularly, the argument has been raised because if we focus solely on rent from rent-stabilized units, and if we look at the difference in the cost-to-rent ratio versus the cost-to-income ratio, we can arguably are creating even greater incentives to deregulate. That's been the debate we've been having all morning. So I'm very curious to hear your response to that.
If you look at just
the concern has been that that we ought to be looking more at cost to rent and perhaps setting aside the income from other sources, from market rate apartments, from commercial units, et cetera, because if we look in the way that you're suggesting, and again in a way that I do understand, at the cost to income, we're actually creating the incentive, an even greater incentive to deregulate and that more units, and ultimately we're destabilizing affordable housing in a way that perhaps is an unintended consequence.
Yeah, I'm not sure how that works, only because deregulation is, a legal process.
No, I understand, but in terms of if we do as you suggest,
right.
Obviously landlords will consider us to be undermining their ability to cover their costs. You're arguing that they've gotten a windfall, and I see the data that's.
It's not even an argument. It's overwhelmingly evident that they've gotten a huge windfall. I mean, a 31.5% rise in inflation-adjusted dollars since 1990, which is completely unwarranted and quite clear from multiple sources.
Okay, I'll let the others raise it, because I see your point, and it's
in terms of what you look at, I think what you need to concern yourselves with is the overall health of the housing stock. And there are a lot of things that go into that overall health, and some of which, and I would suggest unfortunately, because it creates a very painful bifurcation of housing opportunities out there, some of which is the very significant level of deregulation that has gone on in the city, primarily in Manhattan, with the high rent and high income deregulation process. And other things are, there are, income sources that come from other places. Now, how I would respond is that the 62% figure that we used as a benchmark for the outset of rent stabilization factored in what was going on at that time, which was largely the unstabilized stock. It was coming out of rent control, and that stock, when the incomes were measured, it was the full income, including commercial income. So I think that commercial income, is just part of the overall picture. And I think what the board needs to be concerned about is how do we, again, simulate a normal market? And if you're trying to simulate a normal market, it's going to be driven by those changes in costs, the age of the stock, and whatever income pressures are on tenants. I don't think the board should be considering tenant income as tenant income. You consider tenant income as a factor of normal demand, of normal effective demand. As incomes fall, people either double up or bargain, negotiate more aggressively with owners in order to keep rents down. And in some cases, and we've witnessed at least in the recession, the early 1990s, rents actually fell about 15% nationwide during that recession. People will, open market, bargain more aggressively, and doubling up will occur. And by the way, the issue of the surfing that you had mentioned earlier, I'm sorry, Ms. Garcia, yes, we haven't met before. That is largely reflected in the numbers about doubling up, which have increased dramatically in the stabilized stock. So what happens in a recession? People double up, they bargain aggressively, and landlords just recognize that we're going to have to start making deals, and that's evident time and time and time again. But it wasn't reflected in the orders of this board over the last 6 years. What happened was the board, for some reason, just completely ignored those effective demand pressures, which again are a function of a normal market. In terms of what you consider, again, I think you have to consider the overall health of the stock, and that health of the stock is driven by the rents you adopt and the rents that come in from commercial and unregulated sources. Yeah.
So 2 questions for you quickly. So you're saying that the windfall paid to owners and operators of this housing stock is reflected, I would assume, in the high prices for this stock, the sales prices, those that are go to market. That's because we hear consistently that there's such thin margins, expenses have gone up, we're making less and less money, or we have thinner and
Where
thinner
are you hearing
margins.
that from?
From landlords.
Yeah, well, it's BS, with a
Okay,
few
and so,
exceptions. It's
and you're saying that's reflected in,
absolute nonsense.
and then it's reflected in the price, because the price is in contradistinction
Price
to
is
that
driven
argument,
by
I would think.
Price is driven by a lot of other things. Price is driven by, what else is going on in the investment market, what kind of returns other investments are providing. Price is driven by interest rates, and price is driven by, anticipated speculative aspects, condo conversions, stuff like that. So I really couldn't answer that. And I don't think there's many real estate analysts who could really answer that,
Okay.
Quite honestly. But in terms of thin operating margins, in other words, we're barely making it because our expenses are too high. In aggregate and on average, that's absolute nonsense. The evidence from the board, from the income and expense data, and the excessive guidelines the board has adopted over the years show that that's clearly not the case. They are as well off as they are now as they've been for at least 25 years. And with the exception, maybe there was a little bit of an improvement in the 1990s, but that was a time of great prosperity.
And then
I think the owners want to be immunized from what would otherwise be normal market forces in effect.
And then secondarily, since we're coming out of the long recession, I would assume that you would argue that the higher expenses that we've been hearing are related to doubling up and related to the previous testimony of people sort of not being able to afford housing, and that hence operating expenses are gone up because of doubling up and tripling up.
I
and
would
so on.
imagine that that's very limited.
And
Very marginal. I think the doubling up is a real problem,
But
I don't think that the fact that you have 5 or 6 people in a given apartment as opposed to 2 or 3 has a significant impact on cost. It may a little bit on water charges. And if you
I don't
supply
know.
electricity, it might a little bit, but a light bulb will light a room for one person as well as 5 people. Water charges may be a significant change, but that should also be captured in the income and expense.
But at the same time,
Not should be, it is captured in the income and expense.
Yeah, I would suspect as, well, perhaps because as the recession sort of subsides, and hopefully with the mayor's new plan, with additional new housing, there'll be less pressures on that balance sheet, on the owner's balance sheet. The expenses should go down. Has that ever been the trend? Recessionary sort of expenses related to non-recessionary expenses?
Well, expenses have been very flat. I think actually, they did go down 1 year. Did they go below zero? Operating expenses go below zero 1 year?
In which index are we talking about?
The price index.
Yes,
went
yeah,
below zero 1 year?
yeah, yeah. And then there was a couple of years they were close to being flat.
Nonetheless, the board adopted increases.
Just-
At that point, they were in the 2 and 4% range. As I recall, that was not certainly not in the kind of deep recession we recently were.
All right, thank you.
Any questions?
I do. First of all, this was a very articulate, I was completely entranced in every single word that you wrote here, and that you said, and it's very logical, it's empirically driven, all the things that I personally love. Couple of questions for you, though. And I probably am the most vocal of the board members about the NOI numbers and those income ratios, and how I feel like that is a flawed data point. So I need you to understand that going into these questions, that's my perspective.
Yeah, none of these data points are absolutely solid or perfect.
No, I know. And in another lifetime, I romanticize being the person to come up with the formulas that could really give us an accurate representation of rent stabilized apartments, both from an income and an expense standpoint. Couple of points. The simulation of a market, that's actually the first time I've actually heard that statement. And as somebody who's looked at a market and markets, would another measure to look at how rent stabilization, this board has tracked a normal market or a market not in crisis, would be to also take a look at where market rents have gone vis-a-vis the rent guidelines set rents, that growth rate over a long period of time. Because one thing I do want to make note, and this is important for another fact here too, is that it's a unit that goes into rent stabilization. It's not necessarily a building, it's not, and because of our aging housing stock, you're saying that the vast majority of these units are at least 20 years old. So we're talking about units that have been in rent stabilization way longer than this recession, and even in the previous recession.
Yeah, in 1969, it's about 300,000 stabilized units, about 75,000 were pre-war.
Okay.
Today, we've got roughly 1 million, and almost 750,000 are pre-war. That is the rent control stock through the fair market, transition, coming out of rent control, going into rent stabilization, experienced substantial rent increases and then transitioned into the system. So it went from 75,000 to almost 750,000, leaving only, I think, about 30,000 or so left under rent control.
My point is, though, that what we're talking about here, the vast majority, 80 to 90% of the units were in rent stabilization. The units themselves were in rent stabilization prior to this past recession, and prior to the previous recession, and prior to the previous recession before that. One figure that I don't know the facts off the top of my head, I've heard this number, but I don't want to go on the record for it because I don't know it empirically, is I'd love to know how the rent guidelines, rent stabilized rents have increased on average over time, over that same period of time that you were talking about, which I think started in 1990, but I'd even go further back than that. Nationwide. but also look at where New York market rents have gone over that same period of time. And I believe that there's a spread. And I don't know if, again, the number I have off the top of my head, which may be completely inaccurate, is that market rents have increased on average over 5% over 25 years versus rent stabilization rents have increased by, I've heard 3% today, I've also heard 3.5%. So when you're tracking a market, I think that's an important figure to also talk about here, is to look at rent-to-rent comparisons, because that's a little less cloudy than this NOI number, which I have total aja over. The second thing I was going to say, too, is that
Well, let me just say that, I mean, it would be an interesting number, but nationwide asking rents are significantly lower than asking rents in the city. I mean, I'm just thinking about the number I think I came up with was, what was it, 723 or 718 or something like that, going from 2009 to 2013. In fact, the rents dropped over that period. New York City in 2013 were at least around 1,100, I believe, on average stabilized rents. I could check those figures, but somewhere around there. So clearly rents in the city are higher.
Right.
Have they been consistently higher, or has the spread shrunk or grown over the years? I really don't know. I do know that in the last 6 years or so, the spread has grown insofar as rent stabilized rents have absolutely outpaced nationwide market.
But I think you're comparing apples to oranges when you're taking a national market and comparing it to a New York market. I think the better comparison and the more accurate apples to apples comparison would be to take a look at rent stabilized rents in New York compared to New York unregulated rents.
I actually would disagree with you respectfully. The unregulated rents in New York are driven by precisely the imbalances of supply and the supply imbalances that we're concerned about when we regulate the stabilized stock. I think the unregulated stock in New York is really kind of bizarre. It's actually driven by a number of factors, including the influx of almost 1 million new immigrants over the last couple of decades, and limits on housing supply, which I touched on. We really have an anemic level of housing production in the city,
Right.
and it's related to a lot of things completely disconnected with rent regulation. Rent regulation, but remember, you build a building in the city of New York, you only go under rent regulation if you voluntarily opt into it in exchange for a 421A tax abatement. So you can build unregulated housing in the city, which means that housing construction in New York is driven by the market, absolutely driven by the market, but it's contained and restrained by other, legal and other impediments to construction, cost impediments that are a little unique to the city.
But
So
the-
I don't think you can compare unregulated rents to stabilized rents as a valid measure.
But we are a creature, this entire board is a creature of an emergency act as it relates to less than 5% occupancy. I mean, less than 5% vacancy. That is not the case with the nation. And so you are having, by comparing a nationwide marketplace to a subset of a local market, you've created, the baseline is different. They don't have the occupancy or vacancy crisis that we were entirely created to help smooth. So again, we just respectfully, I just respectfully disagree that
I don't
the,
think that the comparisons are, they don't give me a great deal of comfort, because there are a lot of things that can happen in a market, including a market that's subject to rent stabilization for many, many years. All I'm saying when I suggest that the board should be trying to simulate normal rents, the board is kind of an aspirational thing. It's really impossible to know for sure what normal market rents are in this environment, precisely for the reasons that you stated. It's been regulated for an awful long time. But I think what you need to do is you focus on cost increases. You want to preserve net operating incomes against erosion, even in inflation terms. But the fact is that the board didn't preserve net operating incomes against the effects of inflation and that sort of thing. The board vastly increased net operating income
I'm-
guys, I hate to do this, Mr. Collins. I could have you here for 2 hours because this is so helpful, but I know we have several other people to testify and only 40 minutes left. So
Okay.
if we can perhaps have conversation outside of testimony, but please, thank you so much.
But it was a pleasure, and thank you.
Thank you.